I might be at a barbecue or something and someone will say to me, oh, I've never taken a business loan in my life. If you're sitting there scrummaging away, saving all the time, you're not buying that thing or doing the thing, we talk about the opportunity cost. So long as the cost of the funds is lower than what it's returning to you, then it's an investment.
It'll be interesting to kind of get your thoughts on what non-bank lending looks like in 2021 after the year we've just had across different sectors, right? Like I'd imagine some sectors are doing really well and actually need to, they need finance to cover unexpected growth, whereas others have had a hidden revenue and need to cover some of their costs, some short-term financing to bridge them to the next season or through a tough spot. Would that be right?
Absolutely, yeah. I think the most recent lockdowns changed a lot. There were businesses who they kind of stumbled a little bit last year, collected themselves, thought they were off and they were ready to go, and then the next lockdown just kicked their legs out from under them. It was really tricky. But at the same time, there are loads of people out there who are seizing opportunity, who are. They've diversified or they've niched in whatever it is, but they've really better served their audience. So we're seeing a lot of growth loans, and I think due to the low term deposit rates and all of those sorts of things where people have typically placed their money, they don't want to have it there, and they're moving it across to non-bank deposit takers, or there are a number of kind of like boutique financiers out there who are lending their own money because they're just not getting the returns at the banks that they were. So I'm getting calls regularly from lenders going, what have you got for me? Because the motivation's there to lend, and there really are good quality candidates out there too at the moment, I'm seeing.
Because we're almost awash with money, aren't we? It doesn't maybe seem like it in each person's back pocket, but when you've got the Biden administration printing $1.9 trillion and all governments around the world printing money to stave off the effect of locking down the economy for health reasons, where are you seeing that money ending up? Because banks will get a lot of it, but is that what you're talking about, that people are coming to you saying, we've got this cash, we need to invest it in a way and get a return from it?
Yes, and so I'm seeing a lot of we work predominantly in the non-bank space. So we do work with main banks, but most of our work goes non-bank. And that's, the main banks I would consider Westpac, ASB, BNZ, those guys. And then there's a bunch of business-specific lenders, totally separate from the non-bank mortgage lenders, but business-specific lenders. So we're seeing, just so much innovation, and people who part of the succession plan, they're buying more share of the business so the owner can step back, or they're increasing. Cash flow is a big one. You touched on cash flow as well, but growth is expensive. Particularly, you've got construction's a really tough one, but you might be doing the work from the 1st of the month, invoicing at the 20th or the 30th of the month, getting paid on the 30th of the next month, and you don't get paid, so there's that 2-month gap. But also, if you're growing, the cost of doing the work is going up, and then there's this massive kind of uncomfortable phase in the middle there through the growth. So we're definitely seeing that sort of thing as well with manufacture and construction, when there's delays in payments that causing growth pain.
It's a good point, because it's not something I think a lot of people realize if you haven't been a business owner, is that growth is not necessarily a good thing immediately. It's actually a really hard thing because of that financing, because you don't get paid for 30, 60 days, but you've got materials to purchase, you've got this outlay, or you've got labor to expend. Yeah. Then I guess the question for you is then, when do you fund that growth? Because also the fear is, you put that money in, will you truly get the revenue you're expecting?
Yeah, that's a tough one, because I definitely, that fear resonates with me. People are really scared of borrowing money. I think that's where your advisors come in, like your accountant, for example. If you can prepare for that growth, the sooner that you plan for it, the easier it is to borrow against. If you're in a situation where you're mid-growth and you're missing payments on stuff, you start to look desperate, and that's when it's harder to lend. But if you go, look, I'm starting to see a trend, the orders are steadily growing, let's sit down with our accountant, prepare a forecast and see what this is really going to look like. But if you've got a plan in place and you can say we're short here, and then in this month it starts to turn around and this is what we need, lenders like that. They like a plan, they don't like surprises. So if you're already in business and you're suddenly going, everything's hitting the fan and I need this crisis money, they're a lot more wary than, whoa, you didn't see it coming, something's going wrong. But if you go, we know that we're not making money and this is what we're doing about it, and at this point this will happen, they're a lot more flexible.
What can a business do to show that confidence to a lender in terms of trade or contracts that gives the lender confidence in what's being forecast?
Definitely. Black and white it speaks the lender's language. So that's what they really understand the most. But a lot of situations, it's an order that once it's sold, you'll get paid. So forecasting definitely helps, particularly if it's prepared in conjunction with your accountant. So there's rationales and everything's being tested. But contracts, absolutely, terms of trade, absolutely, those sorts of things can solidify it. But if you've got profit and loss statement from last year showing that you weren't, hemorrhaging money, and then you've got a forecast that supports the growth that you're expecting.
So let's then talk an example. Is there any particular sectors where, as a lender, you see a loan from that sector and you go, that's going to be good, we know that sector always performs? Or are there others? Do you treat them all equally, or are there certain ones that are better than others?
From our side, we work with 26 financiers, so we like to have a shot. And another thing that needs to be taken into consideration is the owner of the business and how they're running things, because we might be looking at two businesses from the same industry and we've got different results, and that comes down to how it's being managed. So we like to have a shot, but there are certainly industries that are really being punished at the moment, and I'm fearful of mentioning them for I don't want to scare people away, but definitely hospitality, retail, and clearly tourism. When we see applications come from them, we need a really strong plan in order to, especially if it's cash flow loans. Otherwise, manufacturing is always strong. If you're buying something that's an asset, then they look at the affordability rather than if it's a cash flow loan, that kind of goes everywhere and nowhere. So there's nothing really to secure. But if it's an asset or something where they go, all right, if everything hits the fan, we can sell that, get our money back. They're a lot more comfortable with that. But I think there's more industries that they'd stay away from rather than they're targeting. We like to have, as I say, we like to attempt the application, but there are some that need a lot more support.
So with the manufacturing as an example, let's say there's a business out there that as of the 1st of April 2021, there's an increase in minimum wage that is likely to have a flow-on effect across everyone that works for that manufacturer. Maybe now it becomes more of an incentive to replace some of that labour with automation, or at least shift it onto higher value activities so you can pay that higher rate of wage. What do they need to show you in terms of, here's the capital we want to invest, here's how much money we need for it? What do you look at in terms of number of years? What's the interest on it? How does that asset need to be sweated or secured against the debt?
I think it comes down to how much you're spending. If you're looking for less than, say, 150, then it comes down to affordability, and your time in business is not so scrutinised. We work regularly with people buying and starting businesses, so it's not impossible to be a newbie with a plan. In that instance, they want to see some of your own contribution in there, so a deposit of some sort and an external income. So if your plan doesn't come off, that your personal living costs can still be covered, your loan can still be repaid. So there's a test there, and that can come in the form of, you may be earning dividends somewhere else, rental income, or a spouse is working. And again, a sensible plan, a business plan with a cash flow forecast that they can test the two together and check that what you're saying you're going to do matches up with what the numbers are looking like. And then as the asset gets more expensive, predominantly comes down to servicing. Can you afford it? What other debts have you got? And how are you managing those debts? So bank statements are a massively important component for an assessment. So we look at, are you spending within your means? Are you going in and out of unarranged overdraft? Dishonouring things like that are alarm bells, no matter what your turnover or your profit and loss says. If you're not managing what you have well, then things like that can disqualify you above anything else.
So it's about being clear with what your profit and loss looks like, being clear about the actions you're taking, and making sure that that turns up on your back statement in a way that it gives a lender some confidence in what you're going to do with this money, and having both some forecasts, but also what happens to the downside. How do we protect the downside if this equity doesn't sweat the way we want it to? We can still afford to pay it off from a rental or a second income or an external income if you're acquiring the business.
That's predominantly in the early stages. If you've got an up and running business and you provide me last year's profit and loss or accountant prepared statements in conjunction with your plan or what you're going to do. I mean, you typically, if you're buying a piece of equipment, it's going to add to your productivity. So you should be able to forecast that. So last year's financials with the plan ahead is sufficient for an up and running business. The external income sources and all of that more relates to someone who's got an idea and they want to get started.
What if it's not for equipment per se, whether it's in health or manufacturing or plumbing? What if it's in something that they want to move into a new market or want to go direct to consumer with e-commerce? So it's a part of the strategy is we're going to grow, but it's in a different new part of our business, and we're going to need people more than we're going to need assets. Is that something you'll lend towards?
Yes, absolutely, and we have done so. And again, most of that comes down to affordability. So you either show that through your existing financials, meaning that there's a buffer there, we want to reinvest that into the business to grow, or this is where we're at, this is what we need to do to grow, and here's the forecast of what that will look like. So if you've got an established business that's got a track record of being profitable, being well managed, then some financials to support the fact that you know what you're doing and that your plan's going to work, or, as I say, a forecast about that plan and what the impact of the new funds are going to be. We regularly hear people, I might be at a barbecue or something and someone will say to me, oh, I've never taken a business loan in my life. And I personally think that sounds like a really slow way to do it, because if you're sitting there scrummaging away, saving, all the time you're not buying that thing or doing the thing, and then you get it, and then it starts doing the productive thing that you want it to do, and you go, oh, if I had it sooner, I would have been making all that extra money sooner. So we talk about the opportunity cost. So long as the cost of the funds is lower than what it's returning to you, then it's an investment.
And I think it comes down to how close to the horizon of paying back that debt are you, but also how clear is that horizon of the opportunity. And I think if a business owner is saying, I've never taken on debt, what they're really saying is, I've never done a proper addressable market sizing to work out how big the opportunity is and clarify how much of that market share I can take. Because if you do that part, you might actually be surprised about how much you're underspending, underinvesting, and leaving that for someone else to capture, either through debt or through cash flow.
Yes, and I think that ties in nicely with financial literacy. It's that kind of approach of I'm going to save before I spend is kind of an old-fashioned one and a sensible one. But if you understand how money works and how things grow and the cost of things on the other side of it as well, then you can make a more informed decision, like you were just saying about doing your analysis and going, where are the opportunities, what's it going to cost me to do that, what's going to be the return if I do, and I think that goes quite deep into the financial conversation about literacy across the board. We see people, I say, what's your turnover? And they say, I'm waiting to hear from my accountant. And I'm thinking, wow, you need to have your finger on that pulse, all the time. That should be a piece of information that you just have at hand, along with many of the other pieces of key information on your basic profit and loss statement. But it's information that people are either too busy to understand or not confident enough to ask, what does it mean or how does it work?
And it doesn't need to be scary either. I mean, I grew up in a family where my dad owned a business, my mum owned a business, and they would come home and say, this is what we made today. This is the till take. And you count the cash and the checks back in those days in the 90s, and I'm 9 or 10 years old. And they were excited if it was above the number they'd set themselves for the day. And that's all they did every day, was there was a number and set themselves for the day, because they knew that played into where they were going to go for the year. And then Dad in his business, he had a graph paper. This is kind of pre-computers back I was 6 years old in 1984. And over a period of till 2004, he would graph on this piece of paper for the whole staff to see in the office every year. This is the turnover. And it would be just across and then put a line if it was up, or across and then connect it again, a line, it would go down. In 1987, you see it was like way up and then hits October into 1988, 1990, goes all the way down. But it made it real. You could see if things were going that way, life is good, things are going that way, and it made it a shared burden too. And I think that's something that business owners can think about. If you're getting debt for the right reasons, talk to your staff about what it requires of them to make good on this, because it's a collective effort.
That is such a fantastic insight, actually, about sharing that intel. And again, I refer to quite an old-fashioned mentality of your personal financial situation as a deep, dark secret, and you keep it close to your chest. You don't tell anyone if you're hurting, you don't tell them when you're doing well. But actually in business, those key pieces of information allow other people to perform better. So look, we're investing in this new piece of equipment. This is what it means to the company. This is what we need from you in exchange for doing that. I think that's really a sharp idea.
Particularly in manufacturing, because they are quite big companies in general and have a lot of employees. And from the KIWI original episodes where we've been filming around New Zealand, it's the questions that they put to their team where they get the most interesting and insightful answers, because it's their team individuals that are either suffering from the problem or can clarify the opportunity, which goes back to, if you aggregate all of that and provide that as a plan to your lenders, it's proven from the people that are at the coalface, and then you share, this is what we want to do, get the buy-in, right? So it's not just about the numbers necessarily, it's about getting the team to buy into that plan that's going to be funded with this cash. I guess the reason why I'm really passionate about this is manufacturing in the 20th century is very different from the 21st, and some businesses are ahead of it and are using investment and cash and debt to grab the next cycle, which is automation and digitization. And then others are keeping the cash, paying off buildings, which are expensive, or taking cash out and putting it into the residential market, which is fine for now. But what happens in 5 years or 10 years if you haven't invested where there's these sea change moments? And I think we're in one with digitization and automation now. So even if you're not looking at getting into debt, it would be interesting as a business case, what could you do if you got debt to fund automation, digitization for a manufacturing business? And I think that's reason alone why someone should contact you, Jemma, and at least go through the process with Spinach Business Loans. One question I did want to ask, Spinach, where does the name come from?
I get asked that almost daily, actually, and it's funny because I met with someone recently and they said, whenever my computer freezes, I punch in spinach into Google to see if it's working again, and it's so annoying. Why is you doing that? It's because we couldn't come at it saying we were the biggest, we were the most, we were this, but we can say that we are hardworking, we're dynamic, and we love growth. So I was sitting down with the guys. I can't say that I came up with it myself, but we did a planning day, and that's what came out of it. And they were like, "Yeah, that's us." I think it represents what we're trying to do really well. We like to get in behind Kiwi businesses and support their journey with financial literacy, support them with their business goals, and try and find best fit solutions for what it is they're trying to achieve, so they can go back and support their communities, their employees, and the local infrastructure that they're working in. And I absolutely love it.
It's awesome to hear. I can hear the passion in your voice, and we need organizations like yours that can support businesses with what's needed. It's not just kindness or sales, it's actually support for growth. Yeah. Because it does mean employing an extra person, or it does mean being more efficient and more profitable. And at least within New Zealand manufacturing, 1 in 10 Kiwis works for a manufacturing company. So to have those companies in good health is actually helping all of us. And cash oils those wheels, right?
Yes, it does. And I think one thing that we do well is we know when to pull in the right advisors, whether it's their own advisors, but we look at things and we go, this is where you need to bring your accountant in. This is where you need to get better legal advice. This is where you need to go back and think again. And sometimes we don't provide a solution in terms of one that we get paid on, but we know that if we give the right advice or quality advice, when they do need our services, they come back to us because we can be trusted.
It's having that network. It's not necessarily just the lender or just the accountant. It's also sales, strategy, getting the right people in the room. One of the fascinating things, everyone has a story around money, right? A personal story or a way it is perceived, hold tight to it or let it go freely. Interesting story with a friend of mine who for many years grew his business organically because funding wasn't available. When they finally got the funding, and it was a significant amount, they didn't actually need to use it. And I said, so why did you go through many years of saying that you couldn't get the funding and that was what's holding you back? And he said something that was quite insightful to me, which was, once we had the money, that gave us the confidence to do things that might not work. But actually, because our strategy was so rigorously tested over those years, we didn't need the cash. It actually funded the growth. What we needed was the confidence that if it went wrong, we didn't have to close the business. And the cash gave them the confidence because it was that pillow of months to roll out the strategy that they didn't have that breathing room prior to that.
Yeah, and that kind of goes back to that, what we were talking about earlier about scrimping and saving for everything and missing opportunities as well. It's just knowing when to use the appropriate tools for the appropriate purpose. And if having that approval gave them the confidence that actually, whether they use it or not, they've got the gas in their sails to actually take that opportunity, to make the most of it and to take a risk.
What would be an opportunity you've seen with Spinach that your lending's made a material difference to either the person or to the business? You don't have to necessarily discuss the names.
Yeah, I'd have a few examples. I think some would be where a candidate had been working as a general manager, manufacturing as well, in the business, and part of the succession plan, the owner had offered the general manager to buy shares and then pay them off over time, but wanted them to buy the first 20% up front. And they weren't homeowners, so their main bank weren't interested, and that's where we came along and provided the solutions that we did. We were able to help them fund that initial share purchase so that they could then, start on the journey of taking over the company, which was pretty exciting. And another one, we had a client came through recently. She was trying to buy a business. She'd gone off to her main bank and also to a non-bank, and she had commercial property as security. But at the moment, there's so much uncertainty, so no one likes the security. And we were able to find the solution, but we worked with the vendor, the accountant and the lawyer to find the solution for them, where the vendor helped out a portion and we were able to give non-bank lending for the remainder. It's just about being creative about how you cut the cake. Yeah.
So if someone's got some interest in funding their growth or acquiring a business or taking that next step, if they're employed within the business, and usually owners, the new owners are either from the business or very related to it, to call you at, what's the best way of engaging with Spinach?
Yeah, so 0800 Spinach is our phone number, 774622, or you can connect with me on LinkedIn, or we're accessible spinach.co.nz or info.nz.
Spinach.co.nz. I love it. And I like that Spinach is green, right? You're trading in cash, and spinach is it's the healthiest equivalent of that in the natural world.
It is. And we really love growth money, a lot better than crisis money. I started my own interview series a year ago, trying to inform, because a lot of people that we work with are just so passionate about what they do. They've gone into business, but they're not HR managers, CFOs, and they're coming looking for that crisis money we were talking about earlier. And I thought, if you had things in place sooner, you could have avoided this. And so I just love working with entrepreneurial people who are trying to make a difference to their communities, to their own personal wealth, whatever it is. They're trying to build something, and I absolutely love it.
it's a cool group of people to be around. I'm very fortunate as well to be around that same group. So I'm looking forward to connecting you with that group. There's 1,500 New Zealand made manufacturers, and we'll also share this across our news feeds for those that maybe aren't part of the NZ Made group, but are looking at maybe making a shift this year from employee to acquiring a business, and maybe could do that through some smart lending.
Well, we're here and we're ready when they want to call on us.
Thank you very much for your time today, Gemma. I've appreciated our chat, and look forward to sharing this. And in a couple of weeks, it'll go up on the news feeds for you.
Thank you. Thank you so much for the opportunity.
Thank you for watching this episode of a KIWI Original. If you like what you saw, then hit the subscribe button and you'll get other episodes just like this one in your inbox. Make sure you hit the bell too for notifications, and you'll be served up uniquely Kiwi stories like this one, contributing to New Zealand's future.